Welcome to Talk Tickers. We're here to give you the shortcut, the essential takeaways from Huntington Bancshares' latest earnings call.
That's right. We're diving into their first quarter 2025 results.
And spoiler alert, the numbers looked, well, pretty strong. So let's break down what investors really need to know.
Absolutely. So the headline figure, earnings per common share, came in at 34 cents.
Okay.
And maybe more importantly for gauging profitability, their return on tangible common equity, or ROTCE, hit 16.7%. That's quite robust.
16.7, wow. And what about their core operational earnings before thinking about loan losses?
Yeah, the pre-provision net revenue, PPNR, that was $783 million, significantly up year over year, about 24% actually.
24%, that's huge.
It is. Even adjusted for some notable items, it was still up 18%. So it really shows the underlying engine is performing well.
Okay, so strong profits, but where did it come from? Were they just, squeezing margins, or was there actual growth happening?
Oh, there was definite growth. Both sides of the balance sheet, really. Average loans were up almost $9 billion compared to last year.
$9 billion year over year.
Yep. And even quarter over quarter, they added $2.7 billion.
Okay.
And deposits mirrored that, up nearly $11 billion year over year and $2.2 billion just since the last quarter.
And they emphasize the quality of those deposits, right? Like primary banking relationships.
Exactly. They saw consumer primary relationships grow 3% and business banking up 4% year over year. So deeper ties with customers, not just hot money.
Right. So that balance sheet growth, did it translate into the income statement, net interest income?
It did, yeah. Net interest income grew almost 11% year over year. About 2.2% quarter over quarter.
Nice. And fees, sometimes that gets overlooked.
Fee income was solid too, up over 6% compared to last year.
Oh.
Really driven by payments, wealth management, and capital markets activity.
Okay. And credit quality, any red flags there?
Seemed pretty stable. Net charge-offs were only 26 basis points, quite low, historically speaking.
Good. And capital, how are they positioned?
Stronger. Their adjusted CET1 capital ratio improved to 8.9%. Reported was even higher at 10.6%.
Which probably supports the other big news.
The share buyback. Yeah, the board approved a $1 billion multi-year share repurchase authorization.
Okay, that's a solid snapshot. Let's dig a bit deeper into that loan growth. $2.7 billion sequentially is quite a jump. Where did it come from?
It was pretty balanced, actually. About half, so $1.3 billion came from their newer initiatives.
The expansion areas.
Exactly. The financial institutions group, mortgage servicing funds, finance, and their push into the Carolinas and Texas.
Okay, so those investments are paying off.
Seems like it. The other half, $1.4 billion, came from their, existing core businesses. Corporate and specialty banking, regional C&I lending.
C&I being commercial and industrial.
Right. Though they did mention commercial real estate balances dipped a bit, which offset some of that.
And were they buying this growth with looser terms or lower rates?
They specifically addressed that. Said the new loan yields are consistent with overall production yields. They credited experienced hires and deep relationships, not aggressive pricing.
That's encouraging. Okay, let's flip to deposits. $2.2 billion growth sequentially, nearly $11 billion year over year. That's pretty impressive in this environment.
It really is. They've consistently grown deposits faster than many peers, and that continued. A lot of it seems driven simply by adding more households.
But the really interesting part was the cost, right? Deposit costs actually went down.
Yeah, by 13 basis points down to 2.03%. That outperformed expectations quite a bit. They talked about strong execution of their down beta plan.
Down beta meaning deposit costs don't rise as fast as market rates. How did they manage to lower them, though?
A few key levers. They shifted the mix, fewer CDs, shorter duration CDs, more into money market accounts.
Okay.
They also pulled back on the promotional rates they were offering, what they call go-to-market pricing, and selectively trimmed rates on some existing deposit segments. Plus, a big chunk came from higher rate CDs maturing.
And they kept those customers.
Yeah, they retained them, but at rates roughly 100 basis points lower, which is significant.
Wow. Okay, so strong loan growth, great deposit growth, and lowered deposit costs. That leads us to net interest income and margin.
Exactly. And the net interest margin, or NIM, reflected that, was 3.1% for the quarter, up 7 basis points from Q4.
What drove that increase?
Well, the things we just talked about, higher spread net of free funds, lower drag from their hedging program, and also some interest recoveries helped a bit.
So the underlying margin, stripping out some of those one-off type things.
They put the underlying NIM in at about 3.07%. And importantly, they guided for NIM to be relatively flat around that 3.07% level for the rest of 2025.
Even with different rate scenarios, Fed cuts, no cuts.
Yeah, they seem pretty confident it would hold around that level regardless.
Interesting. Okay, let's circle back to fee revenue. You mentioned payments, wealth, and capital markets. Any more detail there?
Sure. Within payments, commercial payment revenues and treasury management fees showed good strength, up about 6% year over year overall in payments.
Yep.
Wealth management was up a strong 15% year over year, helped by growth in assets under management and just adding more advisory households.
15% is solid.
And capital markets jumped 20% year over year. That was mainly tied to their commercial loan production, things like underwriting and syndications.
M&A still slow.
Yeah, they noted some delays in M&A advisory closings, but said the pipeline looks strong.
All right. What about the cost side of the equation? Expenses.
Non-interest expense actually dipped slightly compared to the previous quarter, mainly lower personnel costs.
Oh, that's good. Are they lowering their full-year expense guidance?
No, they kept the full-year guidance range the same, expecting growth of 3.5% to 4.5%. They said Q2 expenses will likely tick up to around $1.170 billion.
So investing in those growth initiatives we talked about earlier.
Right, investments in revenue producers and just the cost of overall business growth.
Got it. And the capital position improved CET1. And that $1 billion share repurchase, are they planning to use much of it this year?
They characterized it as providing flexibility, but they also said any repurchases in 2025 would likely be, quote, modest.
Modest. So maybe keeping some dry powder given the economy, or focusing on organic growth?
Probably a bit of both. They have historically been somewhat conservative on buybacks compared to some peers.
Okay. Let's talk credit quality again. Net charge-offs down to 26 basis points. What about other indicators? Allowance? Criticized assets?
Allowance for credit losses stood at 1.87%, so still a decent cushion.
And criticized assets? Any movement there?
That ratio did tick up a bit to 3.98%, but management seemed to attribute some of that to just the timing of certain transactions resolving. They said they remain comfortable with modest loss expectations overall.
What's their outlook for charge-offs for the full year?
They're guiding for full-year net charge-offs to be between 25 and 35 basis points, and they expect Q2 to be within that range as well.
So still pretty benign on the credit front, based on their forecast. Okay, let's talk overall guidance and their view on the macro environment.
Well, they actually raised some key parts of their full-year guidance.
Oh, which part?
Loan growth expectations bumped up slightly, now 5% to 7% for the year. Deposit growth still expected at 3% to 5%.
And the big one, net interest income.
That guidance got a significant boost, now expecting NII dollars to be up 5% to 7% for the full year. That's up from previous guidance.
That reflects the strong Q1 performance and the NIM outlook, I guess.
Exactly. Fee revenue guidance remained unchanged, still expecting 4% to 6% growth.
And their commentary on the economy, still cautious.
They acknowledged, increased economic uncertainty, but they expressed a lot of confidence in their strategy, their diversified model, and their ability to outperform peers, even in a tougher environment. They mentioned having action plans ready for different scenarios.
Did they mention any specific impacts like tariffs or anything?
Yeah, they noted some impact from tariff uncertainty, particularly in equipment finance and distribution finance, but they also highlighted that other sectors are seeing benefits or no effect due to diversification and existing trade agreements. Overall, the pipeline for Q2 looked strong.
And those expansion efforts, Carolinas, Texas.
Still going strong. They said the Carolina expansion is accelerating, and they continue to invest in new verticals in other markets like Chicago.
Okay, so wrapping up the core findings, for investors listening, what are the main takeaways here?
Well, I think Q1 really showed Huntington executing well. They're growing loans and, maybe more importantly, core deposits significantly.
And managing the cost of those deposits better than expected.
Right. That NIM performance and the raised NII guidance are definitely positive signals. The growth isn't just volume either. It's deepening relationships.
The share buyback authorization signals confidence, even if they plan to be modest this year.
Yeah, it suggests management feels good about their capital levels and future prospects. And while everyone's watching the economy, their diversified approach and the fact their newer growth initiatives are already contributing, well, that provides some comfort.
It seems like the strategy is working, at least based on this quarter's results.
It certainly looks that way. Strong execution across the board.
All right, time for our This Is Not Financial Advices segment. We try to cook up an outrageous but plausible trade idea based on the call. You go first.
Okay, outrageous but plausible. Huntington highlighted strong growth in payments, specifically commercial payments and treasury management, and noted their new merchant acquiring model is contributing more.
Right.
So the trade idea: a speculative long position in a smaller, maybe less known fintech that provides very niche merchant services, think specialized software for specific industries, perhaps operating within Huntington's key expansion footprints, like the Carolinas or Texas.
The idea being,
that as Huntington builds out its own treasury and payment capabilities, especially in these new markets, they might look to partner with or even acquire a smaller player with specialized tech or customer access to accelerate that build-out. Pure speculation, of course.
okay, niche fintech riding Huntington's coattails. I like it. My turn. Mine focuses on that geographic expansion at the Carolinas, Texas, accelerating branch growth there. So the outrageous but plausible trade. Go long a regional company that specializes in bank branch construction, outfitting, maybe even security systems, specifically one with a strong operational base in the Southeast.
The physical build-out play.
Exactly. If Huntington is really accelerating its physical presence in these growth markets, as they indicated, the companies that actually build and equip those branches could see a nice bump in demand directly tied to Huntington's expansion plans. Again, totally tangential, not actual advice.
Definitely fits the outrageous but plausible brief. So that wraps up our deep dive into the Huntington Bank Shares Q1 2025 earnings call.
We've hit the key numbers, the growth drivers, the outlook, and even some wild trade ideas. Remember, this is all for informational purposes.
We hope this breakdown gave you some valuable insights into Huntington's performance.
So what stood out most to you? Anything surprise you in their results or guidance? We'd love to hear your thoughts. Join the conversation online and let us know.